This is Matthew Cratter from Trade University, and today I want to talk about how to read the Federal Reserve tea leaves and the stock market. It was just 50 years ago last Sunday that President Nixon took the U.S. off of the gold standard. And what has happened over those 50 years? We've now devolved to the point where the most important job on Wall Street, or even if you work for a hedge fund, is reading tea leaves. Earnings don't matter anymore. PEs don't matter. Nothing matters except reading the tea leaves of the Federal Reserve, trying to figure out what the FOMC is going to do and what Jerome Powell in particular is going to do. Will he keep the money printers going? A lot of people like to send me the Shiller PE ratio chart showing us that we're almost back up to where we were in 2000. None of this matters. We're in a completely different regime, and all that really matters is Fed policy. So what I'm going to do in today's video is walk you through a little bit of what happened yesterday. If you're finding this video helpful so far, though, be sure to hit that subscribe and like button. So yesterday, the July minutes from the Federal Reserve's meeting, the FOMC meeting, were released. And as soon as they were released, the stock market took a dump and is selling off. Dow's down about 300 points this morning, or the Dow future. So I'm going to show you what the market saw and why it's reacting the way it is. So you can look up the minutes of the FOMC. They're available online, and they're released with a lag. So these were the minutes that were just released yesterday were from the committee meeting that was held on July 27th through July 28th. I'll link to the actual minutes below. But here we're going to take a look at just the most important parts of it. One of the most important parts that the market really focused in on was this language. Looking ahead, most participants noted that provided that the economy were to evolve broadly as they anticipated, unfortunately this is the way the Fed writes, they would never earn any novelistic or creative writing awards. They judged that it could be appropriate to start reducing the pace of asset purchases this year. So what does this mean, reducing the pace of asset purchases this year? What this means is this is talking about what's called the taper. And as soon as they came out with this, of course, as we said, the stock market has been crashing. But what exactly is a taper? Well, we first have the Fed's balance sheet. This is all the assets that the Fed buys and holds on their balance sheet. We can see that since the beginning of the pandemic, this balance sheet has moved from approximately 4 trillion to above 8 trillion. And this is what everyone's watching. This is what's propping up the stock market. This is what's propping up the real estate market. This is what's propping up everything. There are no longer enough buyers of treasuries. Foreigners, international investors have stopped buying treasuries on the margin about 6 years ago. And what is happening now is really the Federal Reserve is the buyer of last resort. So what exactly is this? Well, a tapering would just mean reducing the rate of purchases by the Fed. So they're currently buying about $80 billion worth of treasuries every month and $20 billion of mortgage-backed securities every month. These mortgage-backed securities are just your home mortgages packaged up and securitized. So this is about $120 billion worth of assets that are being bought every month. What happens in the meantime, or what happens at the same time, is that the assets that are on the Fed's balance sheet, they will eventually mature and roll off. So if they own a bond, it'll eventually mature and the principal will be paid back. So you have things rolling off the balance sheet. But what the taper involves, the taper means that the Fed is going to slow the rate of buying. So, for example, maybe if they're buying $80 billion worth of treasuries now, maybe they'll reduce that to $70 billion worth of treasuries and $15 billion worth of mortgage-backed securities. Now, it's important to recognize here that tapering does not mean shrinking the Fed's balance sheet. We're not talking about taking this and having it go down like this. We're just talking about the rate of increase and whether we're going to allow that to slow, or whether the Fed's going to allow that to slow. So tapering does not mean shrinking the Fed's balance sheet. It just means tapering the rate at which the purchases are being made. Also, tapering does not mean raising interest rates in the sense of raising Fed funds rate, which are the short-term rates that the Fed sets. And the committee made it very clear in the minutes that that this did not involve raising, that any sort of taper did not involve raising interest rates. And the way they say this, when a reduction in the pace of asset purchases became appropriate, it would be important that the committee clearly reaffirm the absence of any mechanical link between the timing of the tapering, in other words, reducing the Fed's rate of purchasing things, purchasing assets like treasuries and mortgage backs, and that of an eventual increase in the target rate of the target range for the federal funds rate. And it goes on to say, a few participants suggested that the committee would need to be mindful of the risk that a tapering announcement that was perceived to be premature could bring into question the committee's commitment to its new monetary policy framework. Now, this sounds very smart and very professional, but what you realize is when if you follow the Fed tea leaves, is that this new monetary policy framework means letting inflation run hot and doing this for particular reasons to get us out of our debt situation, which we're going to talk about in a minute. But this is the new monetary framework. Keep interest rates below the rate of inflation, let inflation run hot, and in this way try to burn through all the debt that the U.S. has. Now, if we take a look at the Fed funds rate, which is a short-term interest rate that's set by the Fed, we can see how broken the system is. This has been a very long and slow decline since the peak in interest rates in the early 1980s, when Paul Volcker, the Fed chairman at that time, broke the back of inflation. We've reached the point of basically zero interest rates. Again, this is the front end of the curve. This shows the part of the debt cycle that we're in and how far gone things are, where the cost of money becomes free at the front end. So when people say that this time's not different, they don't realize that it actually is different. We're at the end of the beginning of the fourth turning. We're at the end of the long-term debt cycle. Interest rates on fiat currencies globally have basically gone to zero. They're negative in parts of Europe. The German yield curve, for example, is completely negative the last time I checked. So we're really at a different point in history. This is what the central banks want, though. They want to keep interest rates below inflation. Bullard, who is a member of the Fed, came out yesterday announcing that he expects the Fed to allow the balance sheet to run off after the taper is complete. So what does this mean? This means actually shrinking the balance sheet. This means not only will the Fed taper its purchases, presumably down to zero, but then they will let things mature and roll off the balance sheet, and they will shrink it. I'll let you take a look at this, and you tell me, has the Fed been able to shrink their balance sheet? Well, they tried to do it in 2018 and 2019. We can see that right here, and they caused a mini stock market crash. So the Fed will not be able to taper. This is just jawboning, and it's very amusing when they say this. It's ridiculous to think that they're going to be able to shrink the balance sheet when they're unable to even taper without causing a strong stock market sell-off. So this is the cycle that happens. We could call it the cycle of abuse between the Federal Reserve and the stock market. The Fed mentions that they might taper. Stocks fall a lot. This happened in the early 2010s. I believe it was 2013. It was called the taper tantrum. And basically what happens is when the Fed mentions a taper, stocks fall a lot. This is the taper tantrum. They're basically calling the Fed's bluff. And then the Fed needs to walk back its language. The Fed cannot taper. The market realizes that the Fed has walked back this language. Stocks go back up to new highs. The price of wood and copper and industrial materials goes up again. Real estate prices go up again. And then the Fed's forced to step back in and say we need to taper. But what's the long-term plan here? The long-term plan is we have the federal government. The whole fiat financial system is basically like a heroin addict. And you cannot, especially when it comes to economies, you really cannot taper. It's probably more difficult than getting a human patient to taper their heroin usage. This is the real chart that should be on everyone's mind. Total public debt, which is the amount of debt that the U.S. federal government owes, and this ignores local debt and corporate debt and off-balance sheet debt. But this ratio of public debt, which is basically treasuries as a percentage of GDP, is at historic levels. It's at it hit 130, 135 earlier this year. What the Fed needs to do is try to get this chart back down to the 50s or 60s. That would be a more normal leverage level. And the only way they can do that is by letting inflation run hot and continuing to purchase treasuries. The real problem is here. We have the U.S. running huge budget deficits. Tax revenue is only $3.8 trillion. Actual federal spending is $7.1 trillion. So there's a deficit. Just like a household, if you're spending more money than you're bringing in, you need to go into debt. That's what the U.S. is doing, and is really doing big time with infrastructure spending bills and one stimulus package after another. We have $28 trillion in regular debt, as we've been talking about. And then when you take into account unfunded U.S. liabilities or off-balance sheet debt, you basically end up with about $154 trillion in debt. So the only way out of this is to let inflation run hot, to let the stock market continue to rally and real estate prices continue to rally. If you taper too much or if you raise interest rates, you'll basically kill tax revenue, a lot of which comes from capital gains in the stock market and the housing market as well, and all of the jobs that are created, for example, by the housing market. And so if you taper, if you try to do any sort of austerity, if you try to cut government spending, you'll end up killing tax revenue, and you'll need to increase debt. You'll need to increase debt anymore. So this is where we are. How do we trade this? Well, I would first point out that we're about to enter September. September is historically the worst month for stocks. A lot of people remember the 1987 crash and the 1929 crash, which were both October crashes in the stock market. That being said, October is actually not that bad of a month on average. September is when really nasty things happen in the stock market, and this talk of a taper is lining up pretty well with the beginning of a difficult period in the stock market, which is really the last half of August, when a lot of traders, a lot of investors are on vacation, proverbially in the Hamptons. Liquidity is low. You can get a lot more volatility and bigger moves. So it's important, if you're trading momentum stocks, for example, to recognize that we're entering historically a very difficult period of time, and the Fed is choosing to do their taper talk at this point, which is causing, really initiating these stock market losses. So if you're trading this, make sure you pay close attention to your stop loss levels. You should probably decrease your size as well. It's much more fun to wait until the fourth quarter. Really, the end of September through Christmas is a great time for the stock market and momentum stocks. So there's no reason to be trading large size now or violating your stop loss levels. For long-term investors, I think you can buy every dip that's caused by taper talk. This is not investment advice, obviously, but if you believe, as I do, that stocks are ultimately heading much, 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 much higher this decade, basically the US dollar needs to be devalued a lot. This will mean asset prices, stock prices, and real estate prices will continue to go up. And so every time there's a taper talk dip, you can safely buy that, I believe, as a long-term investor. And we're talking about indices here, the SPY or the triple Qs. Finally, obviously, which we talk a lot about on this channel, own Bitcoin. The Fed will continue to pump it to the moon, not because they want to, but because they are trapped. We are in a debt crisis. It's a slow motion debt crisis, but the only way out is to monetize the deficit spending and to devalue the dollar. This will continue to send Bitcoin much, much higher. I'm still calling for $200,000 per Bitcoin by the end of 2021. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.